Good morning and welcome to the Morning Spotlight Podcast. I'm your host, Mike Ham, and we are coming to you, as always, from the Spotlight Studios here in Morristown, New Jersey. So our guest today is the founder of Spark Investment Group. He's a real estate expert with more than 4 decades of experience, including 35 years as a realtor navigating the unique real estate landscape in Silicon Valley. During that time, he's invested in real estate ranging from single-family homes and fix and flips to land to subdivisions and condominium conversions to commercial multifamily properties. He's developed a passion for helping others achieve their own financial freedom through investing in multifamily real estate syndications. He is Arn Cenedella. Arn, welcome.
Hey, Mike. Great to be here. Thanks so much for having me on the show, and look forward to chatting with you and hopefully helping your audience get started on their investing journey.
Absolutely. Yeah, I'm excited to have you on. I mean, this is a long time coming because we had a recording date scheduled and that was my fault. But now we're here. So we got you on finally. Very excited about it. So I'm interested just because, like I mentioned to you before we started, we have a lot of people that listen to this show that are, around my age, new to real estate, new in their careers in real estate. And obviously you're someone that comes in with, like I said in the bio that I just read, 4 decades worth of experience. So maybe we'll take it back to kind of like the beginning. So when did Arn get started in real estate?
Well, that's a great question. And it was a long time ago. I started in 1978. I kind of had a typical middle-class American lifestyle. School was important. You were expected to do well in school. College was kind of a given. Went all the way through grad school, have a master's in physical chemistry from the University of Michigan. Go Blue. I'll throw that in, even though their team is struggling a little bit these last couple of years. Yes, they stink. Okay, that's it. So anyway, I thought I wanted to be either a professor or a research scientist. And in the middle of grad school, I just kind of came to the conclusion I didn't really have that burning desire to make original contributions to science. It really wasn't where my heart was. And so I called my dad up, who had remained in the San Francisco Bay Area where I grew up and spent most of my life. And I said, hey, Dad, going to finish up school, get my master's, and then come back to California. And he said, well, come on out, get your real estate license, and I'll put you to work selling houses. So
he was already in the real estate business.
He was in the real estate business, and it was about a 5-minute conversation. There was no long-term planning. I packed up my little car and all my worldly possessions and drove back to California and went to work for him March 1978 in Menlo Park, California, which is next to Palo Alto and Stanford, kind of at the northern edge of Silicon Valley. And that's what I've been doing ever since.
Gotcha. So, and you started obviously as a realtor in the Silicon Valley, right?
Yes.
So
yes.
Describe that experience, because I've been to Palo Alto a couple times because just a fun fact about me, when I used to coach college baseball, I worked Stanford's baseball camps a couple summers.
Yes. Obviously sent my kids.
Yeah.
Yes.
Obviously it's just, incredible there. But I'm just interested to see what the real estate market is like there, like how, like the competitiveness level and all that kind of stuff.
Well, yeah, sure. So first I would say, I was fortunate and blessed just to kind of grow up in the Bay Area, and therefore fell into probably one of the best, if not the best, residential real estate markets in the world. And when I got into the business in the late 70s, prices weren't crazy. In Menlo Park, Palo Alto, we kind of had a rule of thumb, $100,000 a bedroom.
Yeah.
Well, fast forward 40 years now, it's more like $1 million a bedroom. So over these 40 years, prices have probably gone up 10, 15 times. And so I was there through kind of the whole evolution of the San Francisco Bay Area market. Certainly tech and education played a big part of it. When I was a kid growing up in Los Altos, Libby Canned Food Company was the major employer in Santa Clara County. And of course, now it's Silicon Valley to the world, and people from all over the world come there to kind of find their fame and fortune. And residential real estate, like all real estate, is competitive. And certainly as the prices went up, the commission amounts became enormous. Very competitive market. A lot of talented individuals in the industry, and you're working with people who are on the forefront of merger and acquisitions, tech, startups, dot-com boom. So it was a great place to work. I had a lot of fun helping people for 35 years. I was never concerned about being number one. More for me, it was the relationships with my clients, helping them find a home, which is probably everyone's biggest financial decision in their life. And so through these relationships, I built a great referral business, which afforded me a wonderful life. And I've had work-life balance throughout my career, and I feel fortunate to do that. So spectacular place to work, and just fortunate and blessed that that's happened to be where I landed.
Did you see like a now I don't know if this is something that happens, but like when obviously the markets in that area start to like really pick up, and you say you're going from $100,000 a bedroom to almost like $1 million a bedroom, obviously probably not like exactly that, but somewhere in that ballpark. Did you see like an influx of people that just wanted to like ride that gravy train as far as like realtors and stuff like that in that area?
Yes, I would say more people would get into the business as time has gone on, no doubt about that. And I just think more, um, you know, with the global economy, the world is flat. However many people we have on this planet, uh, if you are smart, ambitious, intelligent, where would you want to go?
Yeah.
There might be two or three other places you could think of. And so the influx of people from all over the world really drove the real estate prices with the incomes and the business and the wealth that was created through stock options and so on and so forth. And basically, the San Francisco Peninsula and Bay Area, it's fairly limited geographically.
Right.
And so there wasn't a lot of room. It's not like being in Dallas where you can just drive 50 miles out and find 100 acres of bare land.
Yeah.
It's a more constrained situation, which added to the pressure on property values.
Gotcha. All right. So you're riding the Silicon Valley wave almost, and kind of seeing your basically like your neighborhood kind of change, and the types of people that are there, and just like the way that it's changing. So at what point are you saying to yourself, like, hey, maybe I should start investing in real estate myself and kind of go beyond, what I'm doing as a realtor?
Yeah, that's a great question. So that I have to again point to my father. So my father was born in 1921, lived through the Depression, served in the U.S. Navy, World War II. So totally old school, right?
Yeah, right.
Total different mindset than a baby boomer like me or than a millennial today. No
Like
judgment,
yeah.
no judgment on any of that.
Right.
But
Yeah.
He recognized that real estate investing, as lucrative as the brokerage business is, he realized that real estate investing is really the way to kind of create lasting wealth, right? The incomes are good, but I think you have to put your dollars to work by investing. So he just started buying a house here, a house there, and so forth, and accumulated large portfolios, single family homes. And of course, when he started, you could actually buy a single family home in the Bay Area and use as a rental. By the time I got there, it was starting to get more difficult. But basically, I followed my father's model, and as time, energy, and money allowed, I would buy single family homes both in the San Francisco Bay Area as well as elsewhere in the country. I invested in Charlottesville, Virginia for a while, Austin, Texas. And so I built up a small rental portfolio. And I manage those properties, the local ones myself, because I'm out. It wasn't like I was chained to my desk and had a
Yeah.
9 to 5 career job. Uh, Being out and about, talking to contractors, tenants, buyers, sellers, showing houses was all just part of my day-to-day routine. So I just started accumulating single-family homes, both in the Bay Area and out, and just kind of followed his model. And it's worked well, worked out nicely.
Yeah. So at what point do you go, like, I know you said that it might have been tough in the Bay Area at that time, but at what point do you say like, oh, hey, I'm going to go invest in, what do you say? What are the other places that you said?
Austin, Texas.
Austin, Texas,
Austin,
and
Texas.
Charlottesville.
Yes.
So like, do you have any
Yeah.
connections to those areas, or you just like, hey, Austin seems like a place that might be up and coming. Let me go invest there.
Well, that's a good question. So at one point, my father and his wife relocated to Charlottesville, Virginia. For about 10 years prior, what they did was they'd sell a little rental house in Palo Alto and buy 5 in Charlottesville.
Okay.
Eventually, they moved to Charlottesville. So that was my connection to Charlottesville. And then Austin, Texas is kind of on everybody's radar. Um, and clearly, Texas is a great place to invest. Austin has a great diversity, state university, state capital, and then also tech. Dell Computer was there. And so it was kind of an environment that I was familiar with. And I saw many of the same drivers in Austin from the San Francisco Bay Area and kind of what was going on. Had a conversation with a well-known syndicator in the Texas area, and he says Austin has now become a coastal city,
Yeah.
which is an interesting perspective because it is contemporary liberal blue tech, young folks really booming. The prices have gone up significantly. And Austin's still a great place to invest. I'm actually kind of looking now more to San Antonio, that doesn't have quite that go-go vibe, but maybe there's still a little more value there because Austin is super hot. There's no doubt.
Yeah. Right. So then, so you're in the single family home investing world now. So you've gone from just the brokerage side, now you're in the investing side. So at what point do you start to scale it to even bigger stuff? Because you mentioned in your bio that you're doing, fix and flips, land to subdivisions. Now you're in multifamily. So at what point do you start saying like, okay, this is actually like working for me, and like maybe I should start taking on a little bit more risk and maybe growing out that portfolio with some different stuff?
That's a good question, and I'm probably a little slower than most. So I didn't. So I've been quite happy with my rental portfolio. They've generally been good properties, good locations, kind of a middle income professional salary tenant demographic. They've been in good growth markets, certainly not really cash flow markets. And so they've done well. My capital, my equity has grown. And I guess one of my thoughts is there's always a debate between cash flow and capital growth. And people have lots of opinions about it. Mine may be slightly contrary, but in my opinion, early on in one's working career, in their peak earning years, my recommendation would be to focus on capital growth. Because I think at the end of the day, when you get to retirement, whatever that means these days,
Yeah.
the income off your nest, the income you get in retirement is basically a function of how big your nest egg is. So in my mind, early on, go for capital growth. You're making a good salary. You're paying plenty in taxes. You don't need the cash flow to live on. Focus on capital growth. And that's what I did throughout my working career. Now I'm 66, and I have decided to move more to the cash flow model of investing. So I've spent 2020 kind of liquidating some of my single family rental portfolio and investing it in multifamily properties to scale up my operation that way. And I've done that both as a limited partner and as a general partner. And so I would say I came fairly late to that transition because I actually enjoyed my rental properties. Um, and I don't really have any nightmare stories. Oftentimes you hear of landlords and their
Yeah.
nightmare stories. I just don't have that. I think in 40 years, I've probably had 4 evictions that I've had to deal with, which is kind of an outstanding record. Fairly good at tenant selection, relying on the credit and financial, but also my gut instinct. So the transition wasn't because I had horror stories managing single family rentals, though they do occur. It was more a desire to increase cash flow and also maybe lessen my day-to-day responsibilities.
Right. At what point, like when, what was the largest number of single family homes that were in your portfolio at one time?
I would say I was probably up to about 22.
22. And like, were
So
these,
not
yeah,
huge, but
right.
yeah, yeah.
Yeah. And these were still like, Bay Area, Austin, Charlottesville, or did you start looking at other places as you kind of got more like deeper into the game?
So in 2014, my life partner, girlfriend Laura, and I moved to Greenville, South Carolina in 2014. So when we got here, I started investing heavily in the Greenville
Okay.
area. And so I would say at the peak, probably half of them were in Greenville and half of them were elsewhere across the country.
Gotcha. Okay. And then, at any point, I don't know why this just popped into my head, but at any point, this is irrelevant to like basically anything we've been talking about. Were your Palo Alto connections that maybe you made as a realtor at any point in your investing career, had those like basically almost like a networking type thing? Have those relationships helped from a like maybe it's like a syndication standpoint? Maybe they're getting involved with you from an investing standpoint because you had the relationship with them prior.
Yes, so great insight, and you're absolutely right. So, um, my past friends and clients back in the San Francisco Bay Area have been a big part of my investing. When I first got to Greenville, I bought numerous rentals and then probably had a handful of clients, friends from the Bay Area also buy single family houses in Greenville. And as one of them said, they bought a brand new house in a pretty nice area, nice little 3-2, 215,000. And Linda, the buyer, goes to me, boy, the price of this house is less than a down payment in the Bay Area. And I go, yes, Linda, that's right. So many of them have done that. And then the other thing that I did was start really ramping up the fix and flip business. And of course, in the Bay Area, fixers $1.5 million, and you got to put 700 in, and then you want to sell it for 4 million.
Yeah.
And it's great. I'm a little too conservative for that. So
yeah, those are some high stakes right there for sure.
Yes. Too rich for my blood. So so I did a lot of fix and flips, and I raised significant amounts of money from my friends in the Bay Area, but also many people in Greenville have wanted to do that. And one of the things that's interesting is I've now kind of moved to multifamily, and that's kind of where my focus is and my passion is. And I see a lot of rationale behind the thesis for multifamily investing. But what's been interesting is I thought many of my fix and flip investors would just happily follow me along to multifamily.
Yeah.
But it's a different investment model. In fix and flip, you put the money in for 6 months, you get it back, and then you do whatever you want with it. Where with multifamily, it's a 5 to 7 year commitment. And so what I'm learning is each investor kind of has their own particular needs as to what they want to do. Certainly, some of them have started investing with me in apartment buildings and syndications, and I'm continuing to kind of educate and build that network of investors. Yes.
Gotcha. All right. I don't know why I thought about that, but that was a great answer.
Yes, it's
Yeah,
a
because
resource,
yeah.
and I'm tapping in it. Yeah.
Right. Like I've always been someone that has said like you never really know like where your next business partner or your next deal is going to come from. So it's like it's always good to kind of like keep those networking relationships, those relationships that you have with different people, because you never know what's going to happen. You never know who's going to get like that job that's going to send me a deal from a title insurance standpoint. Like that's happened. Like somebody I never
Yes.
thought would ever be able to send me work sends me work, and I'm like, oh my god, like this is great. So I was just curious.
Yes. No. And if I could just add one other
Yeah.
point. Um, for folks in the Bay Area, many of whom are involved in tech and startups and so forth, much of their net worth is in the stock market.
Right.
And there's nothing wrong with that. My own investment portfolio, I'm probably about 50% in the stock market, 50% in the real estate market, which is probably more heavily weighted to real estate than most people. But one of the discussions I have with my friends back home is if you have 80 to 90% of your nest egg in the stock market, and real estate investment is a good long-term investment, doesn't it make sense to put some of that nest egg into real estate and diversify? And I'm big on diversification, and I can tell you when COVID hit America, March, April, and the stock market dropped 30%, my portfolio dropped 30%.
Yeah.
But my rent checks kept coming in, and I received 100%. So right at that point, the kind of value of diversification was confirmed. Not that I had any doubts about it, but for people who are heavily invested in the market, I think diverting some of that into a different asset class makes a lot of sense.
Yeah, because I mean, real estate doesn't go anywhere. It's like here it is, it's there. Like it's not like to me, like, and I'm not a seasoned investor by any stretch of the imagination, but to me, the stock market is just kind of like, it's like not fake, but it's just like it's not like a tangible thing that you could see and you could touch it, right? So like if you have those properties, like it's like there's one right there, like that's mine, and like it's not going anywhere, and as long as I have somebody living in there, they're gonna be paying me rent, assuming that they are. So I just like I definitely agree with all of that. Yeah.
Thanks. Thank you.
So at what point do you start Spark?
I actually started Spark maybe 6-7 months ago.
Okay.
When
I kind of made the decision. New. Yeah.
Still relatively new. And really my whole multifamily journey started with the conversation due to COVID I had with one of my young investor friends, who is a syndicator himself, a really dynamic young guy doing great. And we had a conversation about COVID and the impact on rents. And he sent me a podcast from a well-known Bay Area syndicator who I tip my hat to, who I've learned a lot from. And that kind of got me started on it. And it was kind of like an epiphany, a light bulb went off, and it just made sense for where I was at and what I want my life to look like to make the transition to multifamily. And then in talking to friends, many of whom have demanding W-2 jobs. I was talking to a buddy, Leo, and he wants to get out of, and I said, you want to get out of the 9 to 5? And he stopped me. He said, Arn, it's not the 9 to 5. It's more like the 7 to 7.
Right?
And he put me in my place, and he was right. He manages engineers all across the world.
Yeah.
So that's 10 p.m. Zoom calls to China or India or vice versa.
Right.
And so through my education and moving into multifamily, I've been able to see a way to help folks who want to get out of the W-2 9 to 5 rat race, a way to do it by creating passive income.
Right, right. So, how do you come up with the name Spark Investment Group? These are the
Uh,
really hard hitting questions we ask on this
yeah,
show. So I'm
yes.
just
Well,
curious.
that's a great. I've never had that one
Yeah,
before, but I'm working with a mentor who helped me set up my platform. Uh, Annie Dickerson and Julie Lamb of Good Egg Investments, and they collaborated with me on Spark. Kind of like that epiphany, kind of like that spark. I think it
yeah,
kind of fits my personality. I'm energetic, I'm passionate. The letters actually kind of mean simplify your investing strategy, preserve your capital, accelerate your growth, reap the benefits through knowledge. And so that's kind of what the acronym means. And I believe that. Having having passive investments does make it more simple. Preservation of capital is key, and I do believe it can accelerate one's path to financial freedom or retirement. So that's how we kind of came up with Spark.
yeah. I don't know. I don't know why. I have the
Yeah,
website open up over here on my other screen, and I was just looking at it, and I was like, I wonder where Spark comes from because
yeah.
I don't know. It's just interesting to see like how people come up, like entrepreneurs. Like you're an entrepreneur because you started this business and you're a real estate investor and all that kind of stuff. So like, I just like the creative side of it because I mean, like, I don't know. I start a podcast. I got to figure out what I'm going to call it. You know what I mean? So stuff like that, I just think is interesting.
Yes, and I may not be the most creative guy. So anyway, I give a lot of thanks to Annie, who is a creative genius, and
Yeah.
they're also in the syndication business. So anyway, they've been a big help, and I owe them quite a bit, and they're a big part of whatever success I'm having, and I'll continue to work with them, and excited to do so.
Yeah, absolutely. All right. So we haven't really asked this question yet. So what is Spark Investment Group? I
Spark
mean, I think
Investment. Yeah,
we've danced around it quite a bit, and I'm sure
yeah,
everybody listening already knows. But let's just define it
yeah.
and like
Sure,
know
sure.
what it's all about.
Sure. So, Spark Investment Group is Arn Cenedella. And what I try to do is use the 40 years of real estate investing experience and knowledge that I've accumulated over time. And trust me, in 40 years, I've been through 3 or 4 economic cycles. I've been through,
A
I could recount
pandemic.
all the events, the pandemic, but the dot-com boom, the dot-com bust,
Yep.
the Great Recession, the subprime crisis, Black Monday in the stock market. Not many people will remember, but in the early 1990s, there was a savings and loan crisis where 1/3 of American savings loans went bankrupt. So, uh, inflation, stagflation, geopolitical conflicts, and through it all, I've just kept investing in real estate. So, uh, my goal, my purpose is, and I'd say through real estate investing, I've had a nice life. I often refer to the good, simple life. My vision isn't a jet setting lifestyle. It's not about fancy cars, but it's about living a day to day existence where it's full and you have friendship, community, you make contributions. You obviously have to take care of business, but there's a holistic approach to it, not running yourself into the ground in pursuit of some corporate success.
Yep.
So Spark is intended to help people, maybe small scale real estate investors, uh, become educated about the opportunities that multifamily investing offers. And Spark is acting as a general partner in apartment syndications, and I will continue to do so. I also do smaller joint venture deals with my investors too. So if there's investors who want to have a little more hands-on experience looking to build their own experience and kind of build their own portfolio, Spark can help them do that. as well as the syndication model for people who want to kind of invest the money and they're busy with their career or family and don't really have the time or energy to learn how to operate real estate rental property.
Right. And remind me again, your multifamily investments are in the Greenville area or kind of
They're mainly in the Southeast and the Mountain West.
okay.
So where I've invested has been Charlotte, North Carolina, Greenville, South Carolina, Columbia, South Carolina, Augusta, Georgia. And then I also love the Mountain West. So I'm in Boise, Idaho, and Colorado Springs. And certainly the people in California know about Boise and Idaho, and they know about Denver and Colorado. So those are great growth markets. And being in the Southeast, I love the proximity, but you see these migration charts or tables, and there's no doubt the population is moving south, oftentimes east, maybe from the coast, they're moving in. And I think if you follow the demographic trends and try to invest in those areas, you're going to do okay on a long-term basis. So I like the geographic dispersity. Texas is a great place too, and I've invested there before. I may go back there, but right now I'm happy kind of in the Carolinas, and that's where my focus is.
Yeah. So the multifamily stuff was something that you only started this year, right?
Yes.
Yeah. Very recent during a pandemic. So like I'm always, because we've had a couple of guys on here that have done syndication and multifamily type stuff. And I'm always curious because like everybody does it a little bit different. So like when you're investing in places that are not Greenville, South Carolina, and you're investing in, wherever, do you actually go visit those properties? Do you go see them? Do you have partners that you work with often that kind of say like, hey, Arn, this is the one that fits your criteria? How does that work?
I would say it's a combination of all of the above. So in the Carolina investments, yes, I go to the property and I put boots on the ground or eyeballs on the asset. And I would encourage your listeners, if they've identified a couple markets that they're interested in across the country, I would strongly recommend that they visit these couple markets, not so much with the idea of finding a particular property, but just getting there, spend a couple days having some fun. What's the vibe of the area? What's going on? Talk to the bartender, to the waiter, talk to the people at the hotel, at the park, whatever you're doing, and kind of get a sense for the area, because I think that can tell you a lot above and beyond the data that you can get online about job growth and population growth. So on the local deals, I definitely checked them out myself. On the Augusta deal, I was part of a team where we walked through all 167 units. Okay, so we had 3 teams of 4 people, and we walked through every unit. So each group walked through about 56 units. In Boise, I'm very familiar with Boise. Some of my friends have moved there. It was a market that I wanted to get in. And when a lead sponsor, operator, syndicator, operator, sponsor had a project in Boise, I took a look at it. The numbers looked good. The property type looked good. So I invested in that sight unseen. And I also followed that investor into Colorado Springs, knowing both were great markets, but no, I didn't go out and visit those. So I think people who are thinking of investing passively need to start listening to podcasts, start getting to know operators, attending webinars with investment presentations, get their investment summaries, and you don't have to invest now. Just kind of start networking and interacting with these people, because I think at the end of the day, as a passive investor, if you're going to give somebody $50,000, $100,000 for a 5 to 7 year period, that operator is basically in control of your money. And I think you need to have some kind of sense that this is an individual who knows what he's doing or she's doing, or somebody that you can trust. So I encourage people to kind of start making contacts within this industry before they invest, gain some knowledge with the goal maybe 6 to 12 months from now making an investment. The other thing I would say is you don't have to put all your chips in on one deal.
Yeah.
If you have a certain nest egg, put a little bit in, get your feet wet, see how it goes, and you'll learn and you'll see how this person operates. Then, 3 months later, you could put a little more in, because investing is a long-term deal. There's going to be the deal of the week every other week. So you don't fear missing out. There's always going to be other opportunities. So I would kind of start slowly, get your feet wet, and then go with there. And then I think what happens is you'll find 2 or 3 operators that you really like and you trust. And then I think you just follow them through their progress and where they invest over the years. Find 2 or 3 you like and just repeatedly invest with them. And it's a great way to build wealth.
Yeah. So I have another question, but I'm going to ask this one first because it kind of ties into what you were just talking about. Like, how do you go about finding the investors that are going to be part of your syndications?
Good question. So, as we alluded to earlier, after 35 years selling real estate in San Francisco Bay Area, I have a fairly sizable database. Some people will invest, most don't. Going on podcasts is a great way. I've got quite a bit of positive feedback. And so podcasts is one, my website, my social media. I'm active on Facebook and LinkedIn. And then it's just networking and talking to people. Another one that's been great for me, kind of moving from single family, small scale investing into multifamily, has been Bigger Pockets. So through Bigger Pockets, I've been able to reach a lot of people who have some investing experience, couple houses here, and they want to do more. And so Bigger Pockets has been another big asset. So it's kind of a multi-pronged approach. And, I have fun doing it. I love talking real estate and networking with people.
Yeah, it's great. I don't invest in real estate myself because I just, don't have the money right now, but I just love being in the real estate world because it's just like so many interesting people and different asset or parts of the real estate industry that you never really think about. But I sell title insurance, and I get to talk to people that, like you, from different parts of the country that are investing in real estate and doing all that kind of stuff. So it's just fun.
And without title insurance, we couldn't do any deals.
Exactly. So make sure you call Mike Ham for your title insurance needs. Shameless plug.
Yes, there you go. No, that's good. Yeah.
Right. Yeah, it's my show. I'll do whatever I want, right? I was curious because I recently recorded an episode with some syndicators from Omaha. So we're actually recording this on December 29th. And I told you this was the 100th episode that we have either posted or recorded this year. So milestone alert from the Morning Spotlight. But the episode that actually posted today, Chris and Colin, their idea of their hold time for these assets is they're looking to hold for forever. Right. And I'm looking at your website right now and I'm looking at the FAQs and just kind of clicking through as we're going through. So yours, how the projected hold time is 5 to 7 years. What's the difference? Why is one better? Is one better? Is it more just from a cash flow perspective? How does that tie into all this?
So I know Chris and Colin, and they're professionals. I hope to be where they are someday. So they're much further on the journey. So give them a plug, and I've had nice conversations with them. So I think it comes down to what, as an investor, do you want to do? And so what I believe in Collins' model is I think they typically do uh, kind of Class C value add properties, which are properties that they purchase. They invest significant time, energy, and money in upgrading the units, increasing the rents. And then what they're able to do is refinance the property and be able to return most of the investment that the investors made in a 2 or 3 year period. So an investor could invest $50,000, $100,000. They buy a kind of a fixer-upper apartment building, fix it up, refinance. In residential terms, it would be the BRRRR method, buy,
Right.
renovate. Okay. So in that model, the investor is getting back most of their investment, which investors like, but they still maintain ownership of the property and they hold it longer term and continue to receive that cash flow. So it's a great model.
Right.
Other people don't build it around a refinance strategy. It's more purchase. It could also be value add. They increase the value of the property. They sell it in 5 years. The investor gets back about 2 times their money. It's a 2-time equity multiple. So in a typical deal, if somebody was to invest 50,000 over a 5 to 7 year period with cash flow and the sale proceeds, they'd get back about 100,000 round numbers. So in that model, the investor will get back a bigger chunk and kind of take their profit and then be able to reinvest that money 5 years down the road into another syndication.
Yeah.
So I don't think there's any great value difference. I think it just kind of depends what the investor wants
Right.
and do they want to be in the deal longer. Some people talk about it in terms of an infinite return because you make an investment, maybe you refi in 2 or 3 years, you get all your capital back. So now theoretically you have zero in the investment, but you still own the property and you receive cash flow. It's not a bad gig. With the economy slowing down a little bit, and I'm an optimistic guy, and we're going to be fine, and things are going to be good. But you also have to be realistic. COVID is going to have some lingering economic impacts.
For sure. Yeah.
So I think it's going to be a little harder to turn these buildings in the near future than it was during a boom economy, which we had from 2010 to 2020 till COVID hit. So I think you might see a little bit longer hold periods on some of these investments. So it'll be interesting to see what happens.
Yeah. I was just interested about that because like I said, we've had a couple different people on here that have done syndication type stuff, and I'm just always interested to see because for someone that does not do that, it like sometimes seems like I'm having like the same type of person, same type of guest on, and I like the core, it's similar, but it's just always to see like the uniqueness of how everybody's operating in this type of space. You know what I mean? So
yes, and that's one of the nice things about it is it's almost like a buffet table or a smorgasbord. So if an investor loves those prime Class A 2018 buildings in major metropolitan downtown areas, and that's what they like, and it's tenants making $100,000 a year, there's a place they can find to put their money.
Yeah.
If on the other hand, investors kind of like more the bread and butter workforce housing, older buildings, not maybe as prime locations, there's a place they can put their money. And there's a rationale for each asset class. And again, some people have strong opinions. A is better than C, C is better than A. I don't really believe that. I think there's rationale behind all of them. And in my own investments, I would say about a third of them are newer Class A properties. Another third are kind of solid B class properties, and the other third are more class C value add deals. And so I feel good because I have a little bit of exposure to each kind of tenant demographic, and kind of the investing dynamics of each of these classes is a little bit different. And so I like kind of having the spectrum that having some kind of diversification provides.
Right. All right. So we're kind of getting close to when we're going to start wrapping up the episode here. But I have a question because I don't know if I mentioned it when we were on air or before we got on air. Most of my listeners are between the ages of 25 and 35. So they're relatively new, whether it's to real estate investing or being in the real estate industry. So you're somebody that started single family homes. You had a good feel for that market because you had a background in that market. Now you're getting into more multifamily syndication. So I know you've used it just because you've used the number a couple times. Like, let's just I'm a young professional in the real estate market, want to get involved. I have $50,000, which would be amazing. What type of advice would you give that person? Would you kind of go the route that you went? Would you take a different route and go the multifamily syndication type route? Does it make a difference? Passive, active, all that kind of stuff?
Yeah, I'm going to kind of punt a little bit.
Yeah, that's what I've expected. Then that's okay.
Yeah. I'm not punting because I don't have my opinion. So I think, yes, so there's a fundamental decision to be made. Do you want to be an active investor or do you want to be a passive investor?
Right.
And I certainly understand and could recommend that if you are kind of interested in actively investing in real estate, and I can't argue with that. That's what I've done. It's a tried and true formula. Millions of people have done it and have created financial security. So going active is perfectly fine. So I would say if you really kind of want to get more hands-on, kind of learn the real estate investing business up close and personal, then what I would do is I would identify a market, because if you're in a San Francisco or New York, 50,000 is probably not going to buy you any kind of house. But
right.
there's you come to Greenville, I'll find you a great brand new house for 200,000.
Yeah.
We'll rent it for 1,400 a month, and you'll do great. So I would say if you kind of want to get your toes wet, use that 50,000 maybe to buy your first single family rental. And that way you can kind of get that experience going. You're going to get some tax deductions. If you buy in the right markets, your capital's going to grow. And you can kind of build that up over time because you start making more money. You can raise additional capital to buy more houses. You can refinance ones that you've owned for 3 years and do that. So I think active, that's the way I'd go. Start with the single family house and kind of learn the investing business. If on the other hand, life is already so hectic that you don't have time to spend with your kids or take your girlfriend to dinner and your plate's totally full with your W-2 or other charity work you do, whatever it happens to be.
Yep.
If you're just so busy, then I think the passive investing route is a great way to go. Find a good market, find a good operator, invest the 50,000 and feel like you're in good hands. Let that operator do what he's going to do. The compensation of the syndicator is going to be a function of how profitable the investment is for you. So the syndicator is motivated by self-interest, because the better the property does, the better he or she does, and the better the investor does. And I think either of those paths would be dandy-fied. So I think that's the big decision, and then from there you go. Yeah.
Okay. Cool. So you mentioned that you're active on social medias and Facebook and LinkedIn, and I know you have the blog on the website. So like, what are some ways that you're trying to get the message out? Is that just that stuff? Is there more? What are the messages that you're getting out? Is it just information?
Yes, so the messages are primarily information. So the blog, my email communications, my social media presence, it's basically providing education. And I would say it's education about two primarily things. One, just real estate investing in general and kind of what's going on in the market in various locations across the country. And then the other part of it's more tailored specifically to passive investing through syndications. What is it? What does it mean? How does it work? What can I expect to earn? And so the first step is education. And then if people are interested, they'll follow through, schedule a call with me. And this could be from Facebook, my website, my blog, a variety of ways. Set up an easy 30-minute call, and we just talk like you and I are about real estate investing. I get to learn a little bit about them, kind of where they're at financially, where they're at in their life, where they're at professionally, what do they hope to accomplish, what's financially feasible for them. And we get to know each other a little bit, again, kind of more education. And if we seem to be a good fit, then I kind of put them in my investor database. And as I get opportunities, then I make them aware of those opportunities and we have further conversations about it. One size doesn't fit all. I think the other thing is before you start investing in real estate, because it is a long-term investment, advisors talk about having a safety net, maybe 6 months living expenses saved. So I think that's critical. So I think before you invest, get that little rainy day fund put away.
Yeah.
Now, any money above that, you can then commit to invest 5, 10 years and it better. But you need that rainy day fund, I think, first before you make a long-term investment.
Yeah, absolutely. All right, so we are going to move the show into our closing segment, which we call Under the Spotlight. So we do this for every episode. So we're going to put Arn Cenedella under the spotlight. So Arn, this is the one thing. So they just listened, the Spotlight listeners just listened to us talk about your business, real estate, your career, the whole thing for almost, I guess, 50 minutes about.
It's been fun. Yes, thank you.
Time flies when you're having fun. I didn't realize we had gone for this long. So what is one thing that you want them to walk away from this episode with?
Well, thank you. Yes. So I would say, one, I think real estate investing is a great thing. I would encourage people to kind of look at it. I think it should be a part of everyone's kind of investment portfolio. And then I think the only other thing I would add is it's a long-term proposition. And one should invest with a 5, 10, 15, 20-year time frame. And what I would say is go for the line drive base hit. You don't need to go for the home run or the grand slam. Just make solid investments over time and you'll turn around 10, 15 years later and you will have accumulated some financial security. So kind of slow and steady wins the race. And if it sounds too good to be true, it probably is.
I love that too, because you threw in the baseball references, which is perfect. So it fits in with the whole, the whole thing. So I
didn't know you were a baseball guy. So that's really interesting.
Yeah. So I went to school here in New Jersey at the college in New Jersey, and played baseball there and then coached college baseball for 4 or 5 years. And then eventually started selling title insurance. So I really went the whole 180-degree turn on the whole career path, but it was fun. It was a great ride, but
it's a great sport. I was horrible in Little League. I could not hit for beams,
Well, neither could I. That's why I was a pitcher.
Couldn't hit.
Yeah.
Oh, you were a pitcher. Okay.
Yeah, I couldn't hit either, so it's all right.
Okay. All right. Good. I'm glad I'm in good company.
Yeah. Right. All right. So for everybody that's listening, that's going to wrap up our show. I am going to put all of Arn's contact information, the website, the email address, the whole thing in the show notes. So make sure that if you are interested in asking him questions, if you are interested in investing with him, you reach out to him. I'm sure he will gladly take your call. I will also make sure that that's what I was going to say. I will put my email address and my contact information also, because if you want to be a guest on the show or hear us talk about a specific topic, make sure you go to the website, themorningspotlight.com, or email us at themorningspotlight@gmail.com. Arn, this was great. Thank you so much for finally getting on here. We could finally get this done. This was awesome.
Well, thanks, Mike. It's been a great hour spending time chatting, getting to know you, and I feel honored being your number 100 guest. So that I'm going to put that on my website as soon as I can figure out how to do it. But anyway, it's a great way to end the year, and I'm looking forward to a great 2021, which I think most of us are ready to be done with 2020, and so I think brighter days are here, and it's a pleasure chatting with you.
You too. I really appreciate it. And everybody else, thanks for listening, and we'll catch you next time.